So how do you minimize UK inheritance tax? Simply put, you raise debt against your assets. Check out this video as I go through the more finer details. Hi there everyone, my name is Simon Mishevich from Optimizer Accountants, and in this video I'm going to be talking about UK inheritance tax and how you can mitigate it by raising debt. But let's go through some of the fine-tuned moments here. So if you want some more information about UK inheritance tax, simply put, you have to just look at the URL that's shown on the screen. So pause this video and get that URL. Look at the details yourself. But I'm going to focus on the key highlights. So £400,000 is the kind of issue that we're trying to avoid, and we want to pay just naught inheritance tax when we pass away. Now, when we think about inheritance tax, you can see the items there. These items are subject to inheritance tax. So we talk about cash, we talk about bank accounts, we talk about property, we talk about fine jewelry, art, etc. But these items are not subject to inheritance tax. So you could invest more money by disposing of chargeable assets and put them into these types of assets instead, such as pensions, agricultural, trade, businesses. Get some real careful tax planning around this in terms of what is a business, a trade business, what is an agricultural business. That is too much for this video for sure, but get some tax planning on that. And then if you gift away assets as well, that's another way of mitigating inheritance tax. Now, a note for foreigners: if you are in the UK for more than 15 years, your worldwide assets will be subject to inheritance tax. So if you're coming from Hong Kong, for instance, you won't even know what inheritance tax is, but you soon will do. Americans have a much bigger value when it comes to estate tax. So the paltry $325,000 in the UK is a bit of an insult. So let's talk about the mitigating factors of inheritance tax. Well, each person gets a £325,000 worth of allowance, which is nice. You also get £175,000 residential nil rates band, which basically means that each individual gets a £500,000 allowance tax-free, which in the global scale of things, £1 million for a couple. Now, when you have assets over £2 million, then the residential nil rate band will dissipate, unfortunately. So make sure you get some tax planning to understand that. So we've got some £3 million worth of assets that we're looking to focus on here. We've got £1 million of liabilities in the form of loans and mortgages, leaving £2 million worth of assets. Those £2 million worth of assets will be reduced further by your IHT allowances, which again is the 325,000 times by 2 if you're a couple, and the 175 residential nil rate band as well. This means that $1 million is subject to IHT. That $1 million subject to IHT means that you're going to be paying £400,000 worth of inheritance tax, which is something that we want to avoid. Now, the tax planning you can do is sell all the UK assets and disappear, or you can increase debts. And that's the thing that we're going to be focusing on, increasing debts. So let's imagine you've got this £3 million worth of assets and you've got this $2 million. Now, basically, if you've got this £2 million worth of assets, you'll be left with IHT allowances of $1 million, giving you no problems at all. So what we're saying is, instead of having £1 million of debt, we're going to increase that to £2 million. Now you could get that on your home. You can refinance your buy-to-let finances, buy-to-let properties, and then you take that cash and spend it. You've earned it, why not spend it? Okay, or give cash over a period of time to your loved ones. There's no issues with capital gains tax as there would be using gifting buy-to-let properties, which is a key thing actually, thinking about raising debts against your buy-to-let properties and then gifting that cash to your loved ones rather than the property itself. So all in all, raising debt does indeed help you to mitigate inheritance tax in full. So some other things that you might want to do here in terms of the money: put your money to a pension. So you have this cash pot now by raising debt against your properties, whether that's your home or your buy-to-let properties. What can you do with it? Invest into a pension, because pensions are outside of inheritance tax, as we talked about before. Go on multiple holidays and then gift your cash. And as long as you live for 7 years of gifting your cash, there's going to be no tax problems at all from a capital gains tax, nor the UK inheritance tax either.